significant peaks in January throughout the 6-month period, meanwhile experiencing significant trough in February. There are many reasons that affect this exchange rate movement. The reason behind this appreciation is because of the United States interest rate cut. US announced its first rate drop in 4 years, lowering interest rate to between 4.75% and 5%. Decreasing the interest rate in the US will make the USD weak. As a result, the MYR becomes stronger. Next, political stability in Malaysia also have a positive impact. After years of political unpredictability, nations saw a more unified government and policy-making atmosphere. Datuk Sri Anwar Ibrahim has consistently worked to draw in possible investment through foreign visits, which have been crucial to Malaysian economic expansion. The effort of Prime Minister has shown the foreign investor that our country is in a stable position and has a promising future. Next, economic growth of Malaysia. GDP in Malaysia in the second quarter of 2024 is 5.9%, which is the highest throughout the year. As a result, the economy has grown slowly in January and made the MYR in January appreciate. Next, the significant trough in February are because of the differential in the interest rate. In 2023, US Federal Reserve raised the federal fund rate by 1%, whereas Bank Negara Malaysia only raised it by 25 basis points. This difference have made the US dollar more attractive to the investor, which led to the increase in the demand for USD. As a result, it has depreciated the MYR in February 2024. Next, because Bank Negara Malaysia only slightly raised the interest rate, there was a gap that caused the money to move out of Malaysia and increased demand for the USD. As a result, it depreciated the MYR during February 2024.
So, next part is economic analysis of Russian ruble against the Malaysian ringgit. The aspect of Russia-Malaysia relations, they have a strong partnership with a growing bilateral trade, as Russia is the largest investor in Malaysia manufacturing sector among the CIS countries. In the aspect of currency trends, Malaysia ringgit appreciated in 2024 due to the domestic and global factors, while RUB weakened due to the geopolitical issues. MYR and RUB are inversely related, hence when MYR strengthens, RUB will be weakened. There are conflicts occur of Russia-Ukraine as the sanctions and the geopolitical tension that caused the hurt to the Russian ruble. Malaysia economic growth in Q2 2024 exceeding the expectation and outperforming regional peers. MYR appreciation supported by strong fundamental boosted investor confidence.
In February 2024, the Malaysian ringgit experienced a significant depreciation against the euro. According to the graph illustrating, the ringgit values dropped January before rebounding mid-February. This fluctuation reflected a combination of domestic economic challenges in Malaysia and the global economic factors in the eurozone, underscoring the interconnectedness of local and international economic developments in shaping currency valuations. There are several factors contributed to the depreciation of the Malaysian ringgit. First, concern about Malaysian economic growth were evident, with a GDP growth rate only 3.7% in 2023. The economy shows signs of slowing. Investor confidence flattered as doubt arose about Malaysian ability to achieve its 2024 growth target of 4 until 5%. Reduced capital inflows and increased outflows weakened the demand for Malaysian ringgit, applying downward pressure on its value. Meanwhile, in the Eurozone, inflation dynamics favored the euro. Although the headline inflation rate declined, underlying inflationary pressures, driven by rising wages and falling labour productivity, remained persistent. The European Central Bank (ECB) signalled its readiness to combat inflation, strengthening investor confidence in the euro. Aggressive monetary policy made the euro-denominated assets more appealing, further driving the appreciation of the euro. From March to June 2024, the Malaysian ringgit staged a recovery against the euro, supported by Malaysian domestic improvement and shifting conditions in the eurozone. On the Malaysia side, robust economic growth and fiscal reforms played a pivotal role. The GDP growth rate surpassed 5% in the first half of 2024, driven by strong domestic demand, particularly in household spending and private investment. Export of key products like semiconductors and palm oil rebounded due to increased global demand. Fiscal reforms aimed at reducing the budget deficit and improving public financial management, coupled with the political stability post-2023 general elections, further boost investor confidence in the Malaysian economy and its currency. At the same time, the Eurozone faced challenges, the manufacturing sector, critical to its economy, contracting significantly. By May 2024, the Purchasing Managers Index (PMI) fell to 47.5, reflecting a slowdown in industrial activity in key economies such as Germany and France. There are 3 contracts overall. The first contract is a forward contract. Forward contracts are customized agreements between 2 parties to buy or sell an asset at a set price on a future date, offering flexibility but carrying counterparty risk due to their over-the-counter nature. The second contract is future contract. Future contracts are standardized agreements traded on exchange, ensuring liquidity and reducing counterparty risk through clearinghouse. However, they require daily margin adjustment and offer limited customization. The third contract is option contract. Option contract grant buyers the right but not the obligation to buy or sell an asset at a specific price within a set period. They limit buyer losses to premium but expose seller to significant risk.
Next, the significant peak for MYR against USD. The factors that contributed to the fluctuation in April are differences in interest rate. This is because higher interest rate from the US Federal Reserve increased the appeal for US assets, which caused the Malaysian capital to move out of the country and raise the demand for USD. Next, factors that contributed to the fluctuation in June are USD strength. US dollar increased month over month in June 2024, indicating that the USD ended the month stronger. Next, seasonal trend also affect exchange rate movement for the USD against MYR. For example, cycles of trade and export. As global trade activity peaks at the end of the year, countries like Malaysia that depend on export experience a spike in demand for their currency. During certain time, this can make the ringgit stronger. Next, the significant peaks for euro against MYR. The factors that contributed to the fluctuation in April is the differences in the interest rate. The robustness of the US economy supported the strength of the USD, which had an impact on the international currency market and make the ringgit stronger. And the reason that affect the fluctuation in June is condition of the world economy. Global capital flow were impacted by US Federal Reserve monetary policy position and rate cutting forecast. Investors shift their portfolio to European assets. And the seasonal trend that affect this exchange rate movement is fiscal year closure and tax remittance. In countries like UK, their fiscal and deadline for corporate taxes are in the first quarter, which is April. In order to pay tax, company might transfer money, which will increase the demand for and possibly strengthen the euro.
So there are cross rate for the April and June. So in April, the USD against the EUR, the bid price is USD 1.0859 and the ask price is USD 1.0772. For the EUR against the USD, the bid price is EUR 0.9283 and the ask price is EUR 0.9209. In June, the USD against the EUR, the bid price is USD 1.0832 and the ask price is USD 1.0831. For the EUR against USD, the bid price is EUR 0.9232 and the ask price also EUR 0.9232. So for the first questions, how does cross rate reflect the economic conditions of the selected currency countries compared to Malaysia? So the first is MYR over USD. The stronger USD could result from a higher US interest rate, the stronger growth or increased investor confidence. Malaysia's economy may face a pressure due to the stronger USD. For the MYR against the EUR, MYR will perform better against the EUR than the USD, indicates that stronger trade relations or external balance with the Eurozone. Malaysia's monetary stability is relative to the Eurozone. So the next questions, what role do geopolitical events play in influencing cross rates? Firstly, exchange rate fluctuations can make a country's good more appealing due to the changing prices, which it creates opportunities for arbitrage and investment strategies based on price differences. An accurate currency valuation relative to the trading partners for crucial for competitiveness in import or export markets. Even in stable geopolitical conditions, determining currency value is complex due to the numerous economic indicators. Thus, geopolitical tensions, military actions, or domestic policy dispute can make a foreign exchange rate volatile and unpredictable.
Now we move to the forward rate calculation. So here is our calculation for spot rate and forward rate for 1 month and 3 months in USD and EUR. When calculating forward rates, several assumptions are made that affect the result. One key assumption is interest rate parity, which suggests that future exchange rates depend on the difference in interest rate between countries such as Malaysia, United States, and Eurozone. This theory assumes no one can make risk-free profits from the difference between spot and forward rates. If IRP holds, forward rates can predict future exchange rates, but real-world factors like government action or market rules can disrupt this balance. Another assumption is that markets are efficient, meaning all available information is already reflected in exchange rates, and price react quickly to new data. However, they ignore practical issues like transaction costs, tax, and market barriers, making the calculation less realistic. Lastly, it is assumed that economic conditions remain stable during the forward contract period, with no unexpected event like financial crisis or political instability. In reality, such events can make forward rates less reliable. While forward rates can estimate future exchange rate if all assumptions hold true, market imperfection, risk premium, and unforeseen events can lead to difference between predicted and actual outcome. Next, the difference between spot and forward rate reflect market expectation. A forward premium where the forward rate is higher than the spot rate. For example, MYR 4.7225 over USD versus MYR 4.5998 over USD suggests the MYR is expected to weaken, possible due to high inflation or low interest rate in Malaysia. Conversely, a forward discount where the forward rate is lower than the spot rate indicates the currency expected to strengthen. For MYR over EUR, forward rate above the spot rate suggests the MYR will weaken against the EUR. However, the slight drop in the 3-month forward rate compared to 1-month forward rate hints at potential stabilizations. These differences show how market view future movement based on interest rate, inflation, and economic stability.
So let's move to the futures contract. For the USD, if we make a decision to take a long position, we may get profit of USD 1,150, while we get loss of USD 1,150 if we take a short positions. While for the European, if we make a decision to take a long position, we will get a profit of EUR 500, while we will get a loss of EUR 500 if we take a short position. So the first question is, what market factors may influence the profit or loss during these trading days? The first factor is interest rate, which is set by central bank, influencing currency markets by determining yield or borrowing costs. A higher interest rate will attract foreign capital, leading to the currency depreciations. Second factor is inflation rates and currency value, which central bank aim to maintain inflation at a sustainable level, which is 2% using interest rate adjustment. Lower inflation rates can strengthen a currency by increasing purchasing power, and a low inflation strengthen the US dollar by making a good cheaper and more attractive to the foreign investors. So the next question is, how will the result differ if the market experience a high volatility during this period? A rational investor consider both returns and risk when making decisions, which crucial to understand its volatility pattern. A pattern in volatility helps investors in better balance in return and risk, which higher expected volatility may lead risk-averse investors to reduce exposure to certain assets. Investors can profit selling during a volatile periods over a week if patterns are identifiable, while higher market volatility may result in losses, especially when purchased future contracts.
Next is a position strategy. In this part, we recommend taking a long position for both USD and EUR futures contracts due to consistent price increases. Profit longs position USD 1150 and EUR 500 indicates a bullish market which reduces a risk and higher potential rewards supported by ongoing upwards trends. The success of long position depends heavily on interest rate as higher rates attract foreign investment structured currency. For example, the US dollar appreciated significantly during the Federal Reserve rate hike in 2022 and 2023. Inflation is another key factor. Lower inflation boost a currency value while high inflation make it weak. Lastly, geopolitical stability support long positions. The USD often act as safe haven during global crises, while the UR is more vulnerable regional instability. Monetary central bank policy, inflation, and geopolitical events is crucial for maintaining profitable long positions.
A higher volatility will raise the price of options, call, and puts. It indicates a higher likelihood of significant price movement in the underlying asset. Selling option strategy may become appealing, such as writing covered calls and writing cash-secured puts, while a lower volatility may result in lower options premiums, making it cost-effective to buy options. Hence, buying options is ideal for speculating on potential price movement. Next, what economic indicators might suggest whether to call or puts? First indicators is GDP growth. A strong growth signals rising stock price, which favors call options, while a slow growth suggests falling price, which favors a put options. Another indicator is inflation. A low inflation supports a rising stock prices on call option, while a high inflation indicates a falling price on put options.
So what is our decision? Our decision is that we recommend buying put option for USD over MYR because we expect the USD to weaken. This is due to possible US interest rate cuts, weak US economic data, and Malaysia's strong economy. Put options make money when the USD loses value. The main reason for this are Malaysia's stable 3% interest rate compared to likely US rate cuts and the US economy slowing down. To manage risk, investors should use stop loss order to limit loss, invest only a small portion of their money in one trade, and use hedging tools like forwards or spread to reduce risk. For EUR over MYR, we suggest buying call option with a 5 cents premium because the EUR is expected to get stronger. This is likely if Malaysia lowers its interest rate and the Eurozone's economy stays stable. This strategy allows for profit hike, keeping risk under control. Next, we move to the exercise price calculation. So this is our calculation for call option and put options. The exercise price on call option is negative 2.6498 and for put option is 6.5498.
When setting the exercise price for option trading, the two factors to consider are time value and volatility. Time decay reduces and option value as expiration approaches. So options with longer expiration typically have higher exercise price to reflect their greater time value. The second one is volatility of the underlying asset. Volatility plays a crucial role in choosing exercise price. Higher volatility increases the chance of significant price movement in the underlying assets, leading to a higher exercise price to accommodate the additional risk. On the other hand, lower volatility will result in lower exercise price. It's also crucial to take implied volatility into account when looking at the exercise price. Implied volatility shows what the market thinks about future price change in underlying assets. The timing of exercising an option is crucial for profitability, as it depends on the underlying asset price, time to expiration, and the option intrinsic and extrinsic value. Intrinsic value reflects the difference between the strike price and the asset current price, while extrinsic value includes time left and market volatility. Exercising early provides the extrinsic value, which could grow if the asset price moves favorably. Unless the factors like dividend or carrying costs justify early exercise, selling the option in the market often yields better return. Understanding these dynamics is key to maximizing profit. For our group assignment, we selected the United States and the Euro to analyze their impact on the Malaysian ringgit due to their economic significance and strong ties to Malaysia. The USD, as the global reserve currency, heavily influences international trade and financial markets. Malaysia's trade relationship with the US includes key imports like machinery and export such as palm oil and electronics. The USD against MYR exchange rate serve as a key indicator of Malaysia's trade balance, economy health, and the impact of the global trends, US interest rate shift, and geopolitical events. Similarly, the euro is crucial due to the EU's status as one of the Malaysia's largest trading partners. The EU imports Malaysia goods like electronics and palm oil, while Malaysia imports machinery and pharmaceutical from the EU. The euro against MYR exchange rate reflects the effects of the European monetary policy, economic trends, and geopolitical events on Malaysia trade and economic performance.
In conclusion, a mix of market-driven political and economic variables will affect the exchange rate. For business and investor, to predict the changes in exchange rate, it is essential to comprehend how domestic economic performance interact with international trends. For forward contract, we also expect that economic conditions will stay stable over the term of the forward contract. For futures contract, it is recommended that investors in Malaysia go for a long position for commodities denominated in USD as well as Euro because it will give them profit rather than going short during the third week of May 2023. For option, it is recommended that the investor put option when the premium is 5 cents because based on the expectation that the USD will further weaken against the MYR.